Hello everyone, and welcome to another edition of ACY Economics and Financial Market Observations. I'm Clifford Bennett, Chief Economist, and today, as you all know, because I'm sure you've read it in 5 different sites by now, the Reserve Bank came out with its statement for this period and has decided to leave interest rates, no one's surprised, at 0.1%. Why are they at this record low of 0.1%? Because there's a national intense crisis and we need crisis level interest rate settings. Aha. But then when we look at the RBA's own statement, we do find some inconsistencies where they talk about the decision to end purchases under the bond purchase program follows how many times have I said this? Follows a review of the actions of other central banks. I've been saying all along, all they do is take what other central banks do and then copy it, and they've actually formalized the process. Sorry, I call them the Reserve Bank of Australia for a reason. They've come out and said that there's no reason to change the interest rate setting, nor do they foresee that there will be interest rate hikes because they don't see that inflation is sustainably in the target zone. By target zone, they mean 2 to 3%. Where is inflation now? Above the target zone at 3.5%. They're worried that they need to support the economy until we have full employment and a target zone inflation level sustainably. Well, in the document itself, it says unemployment is at 4.2%, expected to go lower. GDP growth, their GDP growth forecast for this year is 4.25%. 4.25%. That's what they're expecting GDP growth to be. Unemployment's 4.2%, and they expect that to fall. Inflation's at 3.5%. They expect it to go a little bit higher, then fall back to their target range of around 2.6, 2.7%. Yet, they're leaving interest rates at just 0.1%. Now, markets have reacted this by really scratching our heads. We've seen a little bit of movement in equities. We've seen a little bit of movement in the Australian dollar, but then those movements, the equities moved up because they just thought, well, we still have the world's dumbest central bank, so we'll just keep buying stocks with free money. And then the currency fell because they went, well, there's not going to be any interest rate support for this currency, so it can fall back as well. But what we've seen is a fall in the Australian dollar, then a little bit of stabilisation. We've seen a tick up in equities and then a little bit of a fall back because everyone's trying to figure out this statement does not make sense. And that's why I myself, for several years now actually, but certainly loud and clear over the last 6 months, have been saying, yes, we should follow through on the OECD's recommendations. I mean, it's no small thing. The OECD recommended a review of the Reserve Bank Board and a review of the Reserve Bank Charter, but certainly a review of the board itself. Why did the OECD mention this? It said it was an urgent suggestion in light of the Reserve Bank's performance in recent years. It's not a smart central bank, and I wish Australians would stop acting like we have to support our team like barrack for a football team. No, they're doing us a disservice. We need to sack them. Today, in fact, Peter Costello, former Treasurer of the nation, has come out and said the RBA must be held accountable. This just can't go on. Perhaps with a change of government, we'll have a fresh look at the Reserve Bank and the Reserve Bank Board will be replaced because that is what should happen. I mean, in their own document, they're saying we've got really low unemployment, likely to keep falling. We've got high inflation above the zone, but we're just going to say we don't think it's for sure that it's sustainable yet. I mean, do they have any ability at any form of foresight? This is an incompetent central bank. And then they say on the bond buying program, well, we're stopping buying bonds because that's what the other central banks are doing. I mean, this is the level of ability that the Australian taxpayer is paying for. Okay, enough of that, but basically, it's really bad, people. It's not like some extreme person is having some extreme view. We're talking OECD, we're talking former treasurers, and not just myself, but more and more, there is a groundswell that the RBA just doesn't know how to do this. And that's a ridiculous state of affairs that has to be addressed. Coming back to the financial market outlook, look, It's going to be a little bit dependent in equities on what the US market does tonight. We had a reasonable rally in the US market. It got tired at the end, but then it kicked up in the futures trading. It's a little bit mixed now. I think we'd have a few more hours of upside in US equities, which is obviously completely independent of what's happening with the Reserve Bank of Australia, and then start to tire again. I could be wrong. I'm not as 100% sure the market's going to keep crashing immediately as I was. We got that very right. There's a lot of congestion going on here. What I think we're going to see is about 2 weeks consolidation in the US stock market around these levels, which means it could move a little bit higher, but we're not going to have a bull market rally from here. Just a couple of weeks consolidation, but a broad consolidation, and then go lower again most probably. For Australian equities, what it means is, well, we're not going to have high interest rates in Australia for some time, but there are other reasons to be worried about the Australian economy, such as retail sales down 4.4%, factory activity indexes starting to decline. We've got real problems in Australia anyway, so probably high valuations don't make sense. In regards to the Australian dollar, you know I forecast 70 cents a long time ago. You know I've forecast 65 cents for this year. I still think that is the target. And even the 2023 risk could be 58 cents for the Australian dollar. Another oddity in the Reserve Bank forecast was that unemployment could continue to fall below 4% in 2023. But isn't that when we should be getting an influx of immigration again, foreign travellers, foreign workers? So I'm not sure why unemployment would continue to fall quickly when we're getting an influx of workers. One of the reasons Australia's unemployment is so low right now is, of course, we don't have all those people who would usually be coming in and taking jobs, and so the existing workforce in the country has had to take over and do everything in hospitality, in every industry, to apple picking, to working in mines, to working in offices, to being CEOs of their own companies, whatever everyone's doing, but everyone's very active because of that gap. So I'm not sure that part of the RBA statement stacks up, but it's certainly, this RBA statement, all it says is the central bank in disarray, has no idea. And we could be faced with the prospect for the first time in history of a Reserve Bank board being removed in the next 12 months. And that would be unsettling for markets, but probably a relief actually. But I think equities are not out of jail, they're still in trouble. I think the Australian dollar, given that the Federal Reserve will be tightening aggressively, and you've got to remember that the Federal Reserve is a central bank that is behind the curve. They are behind the curve, and the Reserve Bank isn't even on the playing field. That's how bad we are. So the Federal Reserve is going to be hiking interest rates. And when you look at the Aussie-US exchange rate, you're going to have an economy in the US that's doing reasonably well, but not great. You're going to have high inflation. You're going to have ever higher interest rates. And in Australia, you're going to have a country where the Reserve Bank really is more interested. I think the statement says the Reserve Bank is more interested, more attached to proving somehow that its nonsense notion of not doing anything until 2024 is somehow valid. It's almost like the rhetoric in the statement is trying to prove that point somehow, that they can still hang on to that. So rather than, can we just admit we got everything wrong and do the right thing by the Australian people? So that's why I don't think there's going to be any interest rate hikes in Australia in the near term, as there should be, but there's not going to be. And therefore, the Australian dollar is extremely vulnerable over the next 1 to 3 weeks, and then perhaps the next 3 to 6 months. That's all from me, Clifford Bennett, Chief Economist, ACY Securities. I hope you've enjoyed the show. Please join us again. Thank you very much.